If you are 65 or older, I have about 30 seconds to put real money back in your pocket. In June of 2026, the IRS quietly locked in a rule that lets you deduct 5 kinds of medical bills above just 7.5% of your income. And most retirees never claim it. The average senior leaves about $2,400 on the table every single year. Some leave $5,000. One retired teacher I read about last month left $9,400 unclaimed because her preparer skipped Form Schedule A. If that is you, you can amend last year's return on Form 1040-X, and you can also claim it this year. Stick with me. I am going to walk you through every one of the 5 bills you are now exempt from, the exact form numbers, and the free government programs that will do the paperwork for you at zero cost. Do not turn this off. The biggest payoff is coming around the halfway mark. Now let me slow down for a moment and tell you exactly who is talking to you. I am not a financial advisor, and this is not legal tax advice. I am a tax researcher who reads IRS publications, tax court rulings, and IRS notices every single week so you do not have to. Everything I tell you is based on official IRS rules, real published figures, and the most recent guidance released in June of 2026. The numbers I use are the ones currently published by the IRS for the 2025 tax year you are filing, with the 2026 figures projected from that rule. If the IRS later revises a number, that revision controls and not my number. Always check the current year's instruction booklet for the form I mention. With that out of the way, let me earn your trust by giving you the most useful tax content you have heard all year. Now here's the part nobody talks about. For decades, the IRS let you deduct medical expenses that were more than 7.5% of your adjusted gross income. Then for years, the threshold bounced around and confused every preparer in the country. The new June 2026 guidance locks 7.5% in for good. That might sound small, but it is a giant deal for anyone on a fixed income. Think of it like a grocery store. If your groceries cost more than 7.5% of your income, the rest is on sale. With average medical bills for a senior couple running about $12,000 a year, here's the math. 2 retirees with an adjusted gross income of $50,000 would only need 7.5%, or $3,750 before the deduction opens. Every dollar of medical costs above that small threshold comes off their taxable income. That is real money. Most of you watching this are paying tax on those dollars right now. Before I go any further, please go ahead and tap that subscribe button. The channel is free, it runs weekly, and next week I am covering a different $1,900 write-off, almost no senior claims. Now let me walk you through step 1, the first and most common exempt bill. Doctor and hospital bills. Out-of-pocket medical bills for your primary doctor, specialists, urgent care, emergency rooms, lab work, x-rays, surgeries, and ambulance rides are all part of this deduction. The key word is out-of-pocket. Whatever Medicare did not pay, whatever your Medigap supplement did not pay, whatever your Part D plan did not cover, that is what lands on Schedule A as an itemized deduction. Many retirees stop the moment they see the EOB saying Medicare paid 80%. They throw the bill in a drawer. That is the mistake. If you write a check for the 20%, save the receipt, that 20% counts. If you pay a yearly deductible, save that receipt. If you fly to a hospital visit out of town and you pay $200 in gas and lodging for a medical trip, that $200 counts. Receipts in a folder, folder in a drawer. Drawer that gets opened at tax time. That is the whole system. Now we get to the second exempt bill, and this is where the IRS June 2026 clarification hits hardest. Medicare premium bills. Your Medicare Part B premium, your Part D prescription plan premium, your Medicare supplement premium, also called Medigap, and any Medicare Advantage premium you pay out of pocket, they all qualify as deductible medical expenses on Schedule A. For a typical senior couple, that alone adds up to $3,000 a year or more. Add that to your doctor bills, and most of you are right at the threshold or above it. Most tax software ignores your Medicare premiums by default. You have to manually enter them. If you are using a professional preparer, you have to ask them out loud to add the premiums. Just ask. Say the words, "Please add my Medicare Part B and my Part D and my Medicare supplement." Premium to Schedule A as medical expenses. That sentence alone is worth $1,000 to $3,000 depending on your income and how long you have been missing it. Now let me show you the third exempt bill, and this is the one that surprises older retirees the most. Long-term care insurance premium bills. The IRS sets a separate deduction limit for these premiums based on your age at the end of the year. The published limit for 2025 for someone age 70 or older is $5,880 on qualified long-term care policies, and the limit rises with each age bracket down to age 40. Many retirees pay $1,500 to $4,000 a year for this coverage and have no idea it is deductible on top of the other medical expenses. It goes on Schedule A just like the rest, and the IRS confirmed again in June 2026 that premiums for both traditional long-term care insurance and the newer hybrid life plus long-term care policies work, as long as the long-term care portion is itemized on your premium statement. Request a statement from your insurer that breaks out the long-term care portion. That single page added to the rest of your Schedule A has saved many of my viewers 4 figures on a single return. Now, before I give you the fourth and fifth bills, let me address the moment you may be thinking about. You might be watching this and saying, "I do not itemize. I take the standard deduction. None of this applies to me." That is the biggest myth in retirement tax planning. For tax year 2026, the projected standard deduction is $15,750 for a single filer, age 65 or older, and $31,500 for a couple where both spouses are 65 or older. Those are already enhanced by the senior bonus deduction of $1,950 for a single 65-plus filer. So you start there. Then ask if your total medical expenses on Schedule A pass the 7.5% income test. If they do, you can either take the standard deduction or itemize through Schedule A. Choose the bigger combined result. If your medical expenses plus your other itemized deductions, including property taxes under the $10,000 SALT cap, mortgage interest, and charitable gifts, are larger than the standard deduction, you switch. Most seniors I review are itemizing with medical but do not know it. Now let me give you the fourth and fifth exempt bills, and these are the silent killers retirees forget. Dental bills, vision bills, and hearing bills count on Schedule A if you pay out of pocket. So do prescription drug bills that you pay cash for at the pharmacy, especially the ones Medicare Part D does not fully cover. The June 2026 IRS notice reminds preparers that hearing aids, dentures, eyeglasses, contact lenses, laser eye surgery, and even some transportation costs to medical appointments are deductible medical expenses. Picture a retired couple with $1,700 in dental copays, $1,200 on hearing aids, $400 on new glasses, and $2,200 in prescription copays. That is $5,500 in dental and vision and drug costs in a single year, sitting on the table. Most of those bills get paid by check or by HSA card, and the receipt disappears into a kitchen drawer. Now, here's the part where I am going to slow you down on purpose, because this is where the gotchas live. There are 4 catches you need to know before you go file. Catch number 1. You can only deduct medical bills you actually paid during the tax year, not bills that were billed but not paid. If your doctor sent a bill in December but you pay it in January, it goes on next year's return. Catch number 2. Reimbursements from Medicare or from any insurance plan reduce what you can claim. If Medicare paid 80% and you paid the other 20%, you can only count the 20%. Catch number 3. If you pay with money from a health savings account or an FSA, you cannot double dip. Money that came out of an HSA or FSA is already tax-free, so it does not also get a Schedule A deduction. Catch number 4. 7.5% is calculated on your adjusted gross income, which is the bottom line on the front page of your form. 1040, not your total income or your Social Security. So a senior whose only income is Social Security and a small pension might have a much smaller AGI, which means the 7.5% bar is very low, which means a small pile of medical receipts can wipe out a real chunk of tax. Now let me give you the free filing path that will do all this for you at no cost. If your income is $69,000 or less, IRS Free File lets you use brand name software for free at irs.gov. If your income is $63,000 or less, the Volunteer Income Tax Assistance Program, also called VITA, has IRS-trained volunteers who will prepare your return in person, often at a local library. If you are 60 or older, no matter your income, take this name and write it down. AARP Tax Aid. They run free in-person tax help sites across the United States from February through April, staffed by trained volunteers who already know the senior bonus deduction, Schedule R, and the EITC rules for older workers. They know the 7.5% rule. If you do not remember anything else from this video, remember those three programs: IRS Free File, VITA, and AARP Tax Aid. Each one respects your time, your fixed income, and your right to keep the money that already belongs to you. Now let me give you the one immediate action you can take in the next 5 minutes that puts this whole plan in motion. Pull out a single envelope, label it 2025 Medical, and write Schedule A on the front in marker. Drop in every receipt you have from January 1st through today that touches any one of the 5 bills I just named: doctor and hospital, Medicare premiums, long-term care premiums, dental and vision, and prescriptions. If you have to look up past bills online or call your doctor's office for a year-end receipt, do that this week. Then in January, when this filing cycle reopens, you bring that envelope to VITA, to AARP Tax Aid, or to your own software, and you say the words again. Please add medical expenses on Schedule A above the 7.5% AGI line, and please review whether I should switch from the standard deduction to itemizing. If your preparer or your software refuses, get a second opinion. Free help is available in every state through AARP Tax Aid and through the Tax Counseling for the Elderly program, which the IRS funds specifically for seniors age 60 and up. You do not have to pay anyone to keep your own money. Now let me put a question to you, and I want you to answer in the comments below. Of the 5 bills I covered, doctor and hospital, Medicare premiums, long-term care premiums, dental and vision, and prescriptions, which one do you think you have been missing on past returns? Type the number 1 through 5 in the comments. If you have already amended a return with Form 1040-X for medical expenses, tell me that below so other viewers can learn from your story. If you call the IRS this year, leave the wait time and what they told you. This comment section is the most useful part of the channel. Now let me get to the final recap, because this is where the lifetime savings actually live. Listen carefully. The IRS in June of 2026 locked in the 7.5% medical expense deduction, so it will not expire every few years and confuse your preparer. You can deduct every dollar of out-of-pocket medical bills above 7.5% of your adjusted gross income on Schedule A, including all 5 of the bills named in this video. If you have been missing this for years, you can file Form 1040-X to amend up to 3 prior tax years and recover every dollar you should have kept. The money really does exist. It is sitting in the U.S. Treasury waiting for you to file a piece of paper to bring it home. The only thing between you and the check is the form. If this video saved you a morning of research, share it with one person in your life who is over 60 and might be leaving money on the table. A neighbor, a sibling, a parent, a spouse, your barber if he is over 60. One share has changed how I budget this channel. Now, if you live alone and you are worried about missing a future update, the smallest action that protects you is to tap the subscribe button and turn on notifications so next week's video drops in your inbox. The channel has no paywall, it does not require a membership, it costs you nothing. And every week I will keep covering life-changing senior tax and benefit content that is hiding in plain sight on IRS publications. You will never have to read yourself. Take care of yourself, take care of your money, and I will see you in the next one.